People assume the IRS operates on a punishment mindset. It does not. It operates on a matching and compliance mindset. The system's goal is to reconcile reported income and tax liability with third-party data. It is not sitting there assigning moral value to filings. There is no late filer watch list that you get placed on simply for extending. If that were the case, practitioners who extend most of their complex clients annually would constantly be dealing with audits. It's February, and for some of you, that familiar tight feeling in your chest has moved from a dull hum to a full-blown siren. You've opened your email and seen the subject line start rolling in. Your tax documents are ready. Important year-end statement. Action required. And suddenly, even though there are still weeks before April 15th, your brain is already calculating. Do I have everything? Did I miss something? What if I'm not ready? What if I owe more than I think? And then someone, maybe a friend, maybe a Facebook group, maybe a TikTok tax expert, drops this little gem. If you extend, you're basically asking for an audit, or only people with messy books extend, or my personal favorite. If you don't file by April, you're on the IRS's naughty list. I want you to pause. Take a deep breath. Let's separate noise from reality. As an enrolled agent admitted to practice before the IRS, and as a former IRS revenue agent in the Small Business Self-Employed Division, I can tell you this. The extension is not the red flag. It is not a scarlet letter. It is not an admission of guilt. It is one of the most misunderstood, underutilized, and unfairly judged tools in the entire compliance system. And here's the irony. The very people who are most afraid to extend are usually the ones who should. Because what they're really saying is, I'm not ready. And I'm not ready does not mean I'm hiding something. It means my data is incomplete. My books need reconciling. I'm waiting on a K-1. My 1099-B just got corrected. My brokerage statement changed. The tax system is built on information reporting. And information reporting does not arrive neatly packaged on March 1st with a bow on top. So today, we're going to strip the shame out of the extension. We're going to talk about why the IRS actually prefers accurate extended returns over rushed April filings, the critical distinction between an extension to file and an extension to pay, what due diligence really means under Circular 230, why an extension is not an audit trigger, and how to use the extension strategically, not emotionally. This episode is about clarity over speed. It's about accuracy over ego, and it's about understanding that compliance is procedural, not personal. If you're sitting there thinking, I might not be ready by April, this episode is for you. Let's get into it. Let's start with the why. Why does the extension even exist? From the outside, it looks like a get-out-of-jail-free card for procrastinators. But from the inside, from someone who has worked within the IRS system, it is something very different. It is a pressure relief valve. The IRS processes tens of millions of individual business tax returns. The IRS processes tens of millions of individual and business tax returns every year. The vast majority of those returns are processed through automated systems. Those systems are designed for scale. They are designed for volume. They are designed for matching data, not interpreting chaos. Now here's the part most people don't think about. Information does not arrive evenly. W-2s are generally straightforward and issued early, but 1099s, brokerage statements, partnership K-1s, trust distributions, corrected 1099-Bs, those often arrive late. And sometimes they arrive wrong the first time. Brokerage firms routinely issue corrected 1099-Bs in March, sometimes even April. Partnerships and S corporations may not finalize their books until late spring. Many K-1s aren't issued until summer. Private investments, real estate syndications, those can run even later. If the IRS forced every taxpayer to file a final permanent return by April 15th, regardless of whether their information was complete, the system would drown in amended returns. And amended returns are expensive. They are expensive in time, they are expensive in labor, and most importantly, they are expensive in processing disruption. When you file an amended return, Form 1040X, that generally requires human review. Human review requires staffing. Staffing requires budget, and the IRS does not have unlimited staffing. Automated systems are efficient. Manual processing is not. So the extension serves a very practical function. It reduces amended returns. It encourages accuracy. It smooths the calendar. So the extension serves a very practical function. It reduces amended returns. It encourages accuracy. It smooths the workload curve across the calendar year. When you file Form 4868 as an individual or Form 7004 as a business, you are not stepping outside the system. You are using a feature that is built into the system. It is not an exception. It is an integrated mechanism. Think about it this way. The IRS would much rather process one accurate return in July than process one incomplete return in April and then process a correction in September. Because corrections create movement in the data, and movement in the data creates friction. Let's talk about how processing actually works at a high level. When a return is filed, it enters an automated pipeline. The system begins matching what you reported to what third parties reported: W-2s, 1099s, brokerage statements, payment processors. If your numbers match those information returns, the system moves you forward. If your numbers do not match, the system flags for discrepancy for potential correspondence. Now imagine you file in April without a 1099-B because you haven't received it yet. You estimate capital gains. Then in May, the IRS receives the actual 1099-B showing slightly different figures. Now your return doesn't align with the data the IRS has on file. That discrepancy may generate a notice later, even if the difference was innocent. Had you waited and filed after the 1099-B was finalized, your return would likely have matched on the first pass. Matching equals efficiency. Efficiency equals quiet processing. From an operational standpoint, the extension supports that matching function. And here's something else that rarely gets discussed. April is a bottleneck month. The IRS receives a massive surge of filings in late March and early April. Even with automation, volume matters. When you extend, you are moving your filing out of the peak congestion window and into a lower volume period. Lower volume processing tends to be smoother. Now I want to be careful here. I am not suggesting that extending guarantees faster processing in July. Every situation is different. But from a systemic standpoint, spreading workload across the year is beneficial to the agency. The extension also recognizes something very important. Business accounting operates on real-world timelines, not calendar pressure. Small business owners are closing books, reconciling accounts, waiting on contractor information, correcting categorization errors, reviewing depreciation schedules. None of that happens instantly on January 1st, and the IRS understands that. That is why the extension is automatic. Notice that word, automatic. You do not need to provide a reason. You do not need to justify yourself. You do not need to write an explanation letter. You file the extension, and it's granted. That should tell you something. If the IRS believed extensions were inherently suspicious, they would not make them automatic. Now let's talk about amended returns again for a moment, because this is important. Amended returns trigger manual processing lanes. Manual lanes introduce delays, manual lanes introduce human review, and human review introduces discretion. A clean original filing, even if filed on extension, avoids that additional layer. As a former revenue agent, I can tell you this. When I saw a return that had been amended multiple times, that told me there had been instability in the reporting. When I saw a return filed on extension that was complete and internally consistent, it was not alarming. It was simply filed later. The content matters more than the calendar. And here's another operational reality. Information returns themselves can be corrected. Financial institutions frequently issue corrected 1099s. Partnerships adjust allocations. Brokerages update cost basis reporting. If you file too early, you increase the odds of misalignment. The extension allows the information ecosystem to stabilize before you finalize your numbers. That stabilization benefits both you and the IRS. And let's address the emotional narrative here. People treat April 15th like a moral deadline. It feels like you are either responsible or irresponsible. But in reality, it's an administrative checkpoint. The Internal Revenue Code explicitly provides 6 additional months to file when properly requested. That is not a loophole. That is a statutory structure. If Congress believed that everyone must file by April under all circumstances, extensions would not exist. The tax system is built on documentation. Documentation requires completeness. Completeness sometimes requires time. So when you hear someone say, if you extend, you're asking for trouble, understand that they are speaking from assumption, not from operational knowledge. The extension is not a red flag inside the IRS. It is a workload management tool. It is an accuracy safeguard. It is a system stabilizer. Now, does that mean everyone should automatically extend? No. If your books are reconciled, your information returns are complete, and your numbers are verified, filing in April is perfectly fine. But if you are missing data, if your accounts aren't reconciled, if your brokerage just issued a corrected statement, if your partnership K1 isn't ready, then filing an extension is not weakness. It is a procedural discipline. The IRS does not reward speed. It rewards consistency and accuracy. And the extension exists to protect both. Now we need to talk about the most important distinction in this entire conversation. This is where people get tripped up. An extension to file is not an extension to pay. Say that again in your head. The paperwork deadline moves, the money deadline does not. And misunderstanding that distinction is where real problems begin. When you file Forms 4868 as an individual or Form 7004 as a business, you are requesting an extension of time to submit the return itself. The completed forms, the schedules, the final calculations. You are not requesting more time to pay any tax that is due. Under the law, income tax is generally due by the original filing deadline, typically April 15th for individuals and March 15th for entities. If you owe tax for the year, that liability technically exists on that April date. Now let's slow this down and talk about what happens if you extend but don't pay. There are two primary penalties in play: failure to file, failure to pay. Failure to file is generally the larger penalty. It is typically calculated at 5% per month of unpaid tax, up to a maximum of 25%. Failure to pay is generally smaller. It is typically 0.5% per month of unpaid tax, also capped at 25%. Here's the key. If you file a valid extension, you avoid the failure to file penalty, as long as you eventually file within the extension window. That's significant because 5% per month adds up quickly. But if you do not pay what you reasonably owe by April, the failure to pay penalty and statutory interest may begin accruing on the unpaid balance. That doesn't mean you're in immediate crisis. It means the balance carries costs. Now let's add clarity here. Penalties and interest are calculated on unpaid tax, not on gross income, not on revenue, not on estimated numbers, only the portion that remains unpaid. If you estimate that you owe $10,000 and you send in $8,000 with your extension, penalties and interest would generally only apply to the remaining $2,000, not the full $10,000. That is where strategy matters. You do not need perfect numbers to protect yourself. You need reasonable numbers. Under Circular 230, as practitioners, we have a duty of due diligence. That means we must make a reasonable effort to determine correctness based on available information. It does not mean we must have every final document in hand to make a payment estimate. So how do you estimate when you're not ready? You use logic. Start with last year's total tax liability. Look at your adjusted gross income. Look at your business profit. Did revenue increase, decrease, stay roughly the same? If your business income went up 25%, your tax liability likely increased as well. If revenue declined significantly, your tax may be lower. You can also look at total bank deposits for the year, payment processor reports, payroll reports, quarterly estimated tax payments are already made. This is not guesswork. This is a reasoned approximation, and the tax code allows for reasonable estimates in extension situations. Now I wanted to introduce another concept that often gets misunderstood: safe harbor. There are generally safe harbor rules that protect taxpayers from certain underpayment penalties if they've paid a sufficient percentage of prior year tax or current year tax throughout the year via withholding or estimated payments. The mechanics can vary depending on income levels and specific facts, so I won't oversimplify them here. But the takeaway is this: if you paid in through withholdings or estimates at least what you owed last year or a sufficient percentage of this year's tax, you may reduce exposure to underpayment penalties. Notice the wording: may reduce, not eliminate. Tax law is fact-specific, but understanding safe harbor gives you context. The extension does not exist in isolation. It works within a broader payment framework. Now let's talk about something practical: cash flow. Small business owners often experience April as a double hit. You might owe for last year, and you might also need to make a first quarter estimated payment for the current year. That's a lot of cash leaving at once. The extension does not remove the obligation to pay, but it does give you breathing room on finalizing the paperwork. And sometimes that breathing room allows you to make smarter cash flow decisions. For example, instead of rushing to file with incomplete data and discovering in June that you underpaid significantly, you might use April to make a reasonable payment and then use the extension period to tighten up your numbers and prepare more strategically. Now let's address fear. Some people think, if I extend and don't pay exactly the right amount, I'll trigger something. No, the IRS does not expect psychic precision in April when your books are still stabilizing. What it expects is good faith. If you demonstrate good faith by filing the extension and making a reasonable payment based on available information, you are participating in the system appropriately. That matters. Compliance is not perfection. It is procedural participation. Now, what happens if you truly cannot pay the full amount by April? First, file the extension anyway. Avoid the failure to file penalty. Second, pay what you can. Even partial payment reduces that balance subject to penalty and interest. Third, once the return is filed and the exact liability is known, there are formal mechanisms for payment arrangements if necessary. Those arrangements are separate from the extension itself. The extension is about filing. Payment resolution has its own process. Now let's talk about a mistake I see often. Some people treat the extension as a delay tactic. They file it on April 14th with no payment and think, I'll deal with this in October. That is not strategy. That is postponement. and postponement increases cost. The extension is designed to allow you to refine your numbers, not ignore them. If you use the 6 months to reconcile accounts, verify income, correct categorization, and document deductions, you are reducing risk. If you use the 6 months to avoid thinking about the issue, you are increasing it. Intent matters, procedure matters, follow through matters. And I want to end this section with a reframe. The extension is not a loophole. It is not a delay button. It is a structured compliance options that acknowledges the reality of modern financial reporting. When used correctly with reasonable payment and diligent follow-up, it is a sign of responsibility, not avoidance. The IRS does not punish you for using a tool it built into the system. It evaluates whether you fulfilled your obligations within that framework. File on time, meaning file the extension by the deadline. Pay reasonably, meaning make a good faith estimate. Finish the job within the extension window. That is the golden rule. Let's address the thing that's really sitting underneath all of this, the fear. The sentence I hear constantly: I don't want to extend because I don't want to trigger an audit. This belief is incredibly common. It's also incredibly persistent, and it is not grounded in how audit selection actually works. Now, I want to be careful here. I'm not going to share confidential selection criteria. I'm not going to speculate, but I can explain the general framework of how audit selection functions at a high level. Audit selection is data-driven. It is not calendar-driven. When a return is filed, whether in February, April, July, or October, it moves through the automated screening systems. These systems analyze numbers. They do not analyze your emotional timeline. They compare reported income to third-party information returns. They evaluate deduction ratios relative to income. They compare your return to statistical norms for similar income brackets and industries. They look for outliers. That's the key word: outliers. If you report $500,000 of gross receipts and $495,000 of expenses, that may be an outlier. If you report zero income but substantial 1099 reporting exists under your Social Security number, that may be an outlier. If your charitable contributions suddenly triple with no corresponding income change, that may be an outlier. The system is looking for numerical irregularities, not filing dates. Now let's think about this logically. Millions of taxpayers file extensions every year. High net worth individuals extend routinely. Large partnerships extend routinely. Corporations extend routinely. Complex businesses extend routinely. If extension status alone triggered audits, the IRS would probably be audited massive portions of the filing population annually. That does not happen because the extension itself is neutral. It is procedural. Now let's go deeper. There's something called pattern analysis. Again, without getting into confidential mechanics, the IRS does look at patterns over time. But pattern analysis relates to reporting behavior, not to whether you filed in April or October. For example, if you consistently report income within a predictable range year after year, that's a stable pattern. If your business expense ratios are consistent with industry norms year after year, that's a stable pattern. If your numbers fluctuate dramatically with no explanation, that may draw additional scrutiny. Notice what's missing from that list: the calendar. The IRS is not asking, did this taxpayer file in April or July? It's asking, do these numbers make sense? And this is where I want to reframe something important. In some cases, filing too early can actually create more mismatches. Let's say you file April 1st. You're still waiting on a corrected 1099-B. You estimate your capital gains. 2 weeks later, the brokerage issues a correction. Now the IRS receives information that doesn't match your filed return. That mismatch may generate a notice. Now compare that to filing in June after the correction is issued. Your reported numbers match what the IRS has on file. Which scenario creates less friction? The extended one. The extension did not increase risk. It allowed alignment. And alignment reduces correspondence. Now let's talk about something that sometimes gets misunderstood. People assume the IRS operates on a punishment mindset. It does not. It operates on a matching and compliance mindset. The system's goal is to reconcile reported income and tax liability with third-party data. It is not sitting there assigning moral value to filing speed. There is no late filer watch list that you get placed on simply for extending. If that were the case, practitioners who extend most of their complex clients annually would constantly be dealing with audits. They are not. Now I want to make an important distinction. An extension does not protect you from an audit. If your return contains substantial errors, unreported income, or inflated deductions, filing an extension does not shield you from review. The content of the return matters. If you use the 6-month extension to get creative, meaning you attempt to stretch deductions beyond defensible positions, that may increase risk. But that increase is tied to substance, not timing. Audit selection is about numbers, documentation, and consistency, not about whether you pressed e-file in April or July. Now let's address something subtle. Some people say, if I extend every year, that looks suspicious. No. If you extend every year and your returns are consistent and accurate, that becomes your pattern. Consistency reduces suspicion. Inconsistency increases it. If you file April one year, extend the next year, amend the next year, and then file late without extension the next year, that creates variability. But extending annually with accurate filing is simply a filing habit, and habits are not inherently risky. Let's talk about revenue agent perspective for a moment. When I conducted examinations, the first thing I reviewed was not the filing date. It was the return itself. I looked at income. I looked at deductions. I looked at supporting documentation. The filing status, April versus extension, was not a determining factor in whether I selected an issue for development. What mattered was whether the documentation supported the reporting. And here's something that might surprise you. A well-prepared extended return often reflected more thorough reconciliation because the taxpayer had taken the time to clean up their books. Time can improve defensibility, and defensibility is what matters in an audit. Now I want to address the psychological layer here. April 15th feels like a compliance finish line, and humans tend to believe that crossing finish lines early equals virtue. But tax compliance is not about virtue. It's about accurate reporting with statutory deadlines. The extension is a statutory deadline. It is built into the law. It is not a violation of the law. It is a lawful adjustment of the filing timeline. When you use it properly, you are not stepping outside compliance. You are operating within it. So let's replace the myth with a more accurate framework. Extensions do not increase audit risk. Inaccurate reporting increases audit risk. Unreported income increases audit risk. Unsupported deductions increase audit risk. Large unexplained fluctuations increase audit risk. Filing date alone does not. Now I'll add one more practical thought. If you are nervous about audit risk, the best thing you can do is reconcile your accounts, match your 1099s, document your deductions, keep contemporaneous records, review your ratios year over year. That work matters far more than whether you filed in April or October. Compliance strength is built on documentation, not speed. So if someone tells you, I'd never extend, that's asking for trouble, you can calmly respond. The IRS evaluates numbers, not calendar dates. And that's the truth. Now I want to shift the conversation slightly. Up to this point, we've been talking about extensions from a taxpayer's perspective. Now I want to talk about them from a professional responsibility perspective. Because whether you hire a preparer or you prepare your own return, there are standards involved. And for those of us who practice before the IRS, enrolled agents, CPAs, attorneys, we operate under Treasury Department Circular Number 230. Circular 230 governs practice before the IRS. It establishes standards for due diligence, competence, and ethical behavior. And when you understand those standards, something becomes very clear. The extension is not avoidance. In many cases, it is compliance discipline. Let's start with Rule 10 diligence. Rule 10.22 requires practitioners to exercise due diligence in preparing, approving, and filing tax returns and other documents submitted to the IRS. Due diligence means making reasonable efforts to determine correctness. It means verifying information. It means reconciling discrepancies. It does not mean rushing. It does not mean filing incomplete work to meet an arbitrary emotional deadline. If I know that a client's books are not reconciled and I rush to file anyway, that is not due diligence. If I know that a 1099 is missing and I estimate without verification, that is not strong procedural practice. The extension creates space for due diligence. It allows for verification. It allows for reconciliation. It allows for correction before submission. Now let's talk about Rule 10.21, knowledge of client's omission. This rule states that if a practitioner knows a client has not complied with tax laws or has made an error or omission, the practitioner must advise the client of the fact and the potential consequences. That's important. If during March review we discover the prior year depreciation was calculated incorrectly, or that income was omitted, or that a deduction was overstated, we cannot ethically ignore that to meet April 15th. We have an obligation to address it. Sometimes addressing it requires more time. Sometimes it requires reconstructing records. Sometimes it requires amending prior year returns. And sometimes it requires slowing down. The extension allows for that slowdown. Now I want to be very clear here. The extension is not a shield against compliance. It does not excuse inaccuracy. It does not allow you to delay indefinitely, but it does provide lawful time to ensure that what you are filing is correct. Professional compliance is not about speed. It is about defensibility. And that word matters, defensibility. If a return were examined, could you explain how the numbers were derived? Could you show documentation? Could you demonstrate reconciliation? If the answer is yes, that's defensible. If the answer is we rushed because we didn't want to extend, that's not strong positioning. Now let's talk about something subtle. There's often social pressure around filing early. People say things like, my preparer got me filed in February, as if speed equals competence. In reality, complex returns filed in February are often filed on preliminary information. Many large firms extend automatically for this reason. They wait for final K1s. They wait for finalized brokerage statements. They wait for the year-end adjustments. This is normal in the professional world. Extending is not rare among complex filings. It is routine, and it is done intentionally. Now let's bring this back to small business owners who prepare their own returns. Even if you are not governed by Circular 230 because you are filing your own return, the principles still apply. Due diligence still matters. You still want your numbers reconciled. You still want your income matched. You still want your deductions supported. The extension is a tool that allows you to practice personal due diligence. Now, I want to address something that sometimes gets misunderstood in the compliance space. Taking more time does not increase risk. Careless filing increases risk. If you use the extension period to shop for deductions, stretch positions, or inflate expenses beyond reasonable support, that increases exposure. But if you use the extension period to verify, reconcile, and document, you are strengthening your compliance posture. There is a difference between delay and diligence. Delay is avoidance. Diligence is verification. The extension supports diligence. Now let's talk about internal discipline. When you file an extension, you are making an implicit commitment. I will use this time productively. That commitment matters. If you extend and then wait until October 14th to start reconciling accounts, you have not used the tool properly. Professional practice treats the extension as an opportunity for structured review. Here's what that often looks like: reconciling all bank and credit card accounts, matching income deposits to 1099 totals, verifying contractor payments, reviewing depreciation schedules, confirming carry forward amounts, ensuring prior year adjustments were properly implemented. That level of review is not always possible in the compressed window between February and April, especially for business owners juggling operations. The extension expands that window. Now, I want to zoom out for a moment. Circular 230 exists to protect the integrity of the tax system. It is designed to ensure that returns filed are supported, accurate, and ethically prepared. The extension aligns with that purpose. It reduces rush filings. It reduces preventable amendments. It reduces careless omissions. When used correctly, it strengthens compliance. And I want to make something else clear. There is no ethical requirement to file early. There is a requirement to file on time. And on time includes a properly filed extension. That is statutory compliance. The law allows it. The regulations allow it. The IRS processes it automatically. Using it does not signal weakness. It signals understanding of the procedure. So if you are a business owner feeling embarrassed about extending, or if you are a preparer feeling pressured by clients to rush, pause. Ask yourself, are the numbers reconciled? Is the income verified? Are the deductions documented? If not, the extension may be the most compliant choice available. And compliance, not speed, is the standard. Because at the end of the day, the filing date will not matter if the return is accurate and defensible. But the filing date will not save you if it is not. Professional discipline sometimes looks like slowing down, and the extension exists to make that lawful. Now I want to talk about something that rarely gets discussed in tax conversation: the psychology of April 15th. Because the extension debate is not really about forms, it's not really about penalties, it's not really even about audits, it's about identity. April 15th feels moral. It feels like a pass fail moment. It feels like I either handled my business or I didn't. And that emotional layer is powerful. We live in a culture that equates speed with competence. Early equals responsible, fast equals organized, late equals behind. But the tax system is not built on emotional symbolism, it's built on procedural structure. And here's something interesting. If April 15th were truly a moral line in the sand, the law would not provide an automatic 6-month extension. It would not be embedded in statute. It would not require no explanation. The existence of the extension tells you something important. The system anticipates delay, not because taxpayers are responsible, but because financial reporting is complex, and complexity requires time. Now let's talk about why small business owners especially internalize a role so intensely. When you run a business, you are already carrying responsibility. Payroll, vendors, clients, operations, cash flow. There's pride in keeping things moving. There's pride in meeting deadlines. So when April approaches and you think, I'm not ready, it feels like a personal failure. But here's the reality. Running a business and closing books are two different skill sets. Revenue generation and financial reconciliation are not the same discipline. And if you're building, scaling, hiring, marketing, serving clients, it is entirely possible to have a profitable year and still need the additional time to clean up the reporting. Needing time does not mean you failed. It means you are prioritizing accuracy over ego. Now let's talk about ego for a minute. There is social signaling around filing early. People say things like, I already got my refund, or my taxes are done. There's an implied virtue in that. But early filing is only virtuous if it is accurate. Filing early with incomplete data is not responsible, it's reactive. And sometimes that reaction is driven by anxiety. We want the stress to be over. We want to check the box. We want to feel done. But compliance is not about feeling done. It's about being correct. Now let's go deeper. April 15th triggers something else. Scarcity thinking. If you owe money, that deadline feels threatening. And when something feels threatening, the instinct is to either rush or to avoid. Rush filing can lead to careless errors. Avoidance can lead to procrastination. The extension offers a third option, structured pause. It says, we will handle this, just not recklessly. And structured pause is mature compliance. Now I want to address something subtle that I've observed over years of working with business owners. High performers often struggle more with extending than disorganized people because high performers don't like loose ends. They don't like unfinished tasks. They don't like admitting something isn't complete. But extending is not admitting incompetence. It's acknowledging process. The most sophisticated taxpayers in the country extend routinely. Large law firms extend. Investment partnerships extend. Private equity firms extend. Complex estates extend. Not because they are sloppy, because they are thorough. They understand that financial reporting has layers, and they respect the layers. Now let's talk about shame. Some people feel embarrassed to tell their accountant, I'm not ready. They feel like they should have been more organized. But bookkeeping cleanup is common. Missing 1099s are common. Corrected brokerage statements are common. Late K1s are common. There's nothing rare about needing more time. What's rare is someone calmly saying, I'm going to use the extension strategically. That calm confidence changes the emotional dynamic. Now let's zoom out even further. Entrepreneurship often attracts risk-tolerant personalities, people who move fast, people who iterate, people who adjust on the fly. That works beautifully in business. It does not always translate cleanly into tax compliance. Tax compliance rewards documentation, reconciliation, verification. It rewards precision. Those are slower skills. The extension bridges that gap. It gives fast-moving entrepreneurs the time needed to match slower-moving documentation systems. And that is not a weakness, it's adaptation. Now here's another psychological layer. People fear being on a list. There's this vague idea that if you extend, your name goes somewhere, that the IRS is watching, that you've drawn attention. But think logically. If millions of taxpayers extend annually, which they do, that list would be massive. Extension is normalized inside the system. It's not escalated. The emotional fear does not match procedural reality, and fear-based compliance is unstable. It leads to reactive decisions. Confident compliance leads to stable decisions. Now let me offer you a reframing exercise. Instead of asking, what will people think if I extend? Ask, what will my documentation look like if I rush? Instead of asking, will the IRS notice I extended? Ask, will the IRS notice if my numbers don't match? Because the second question is the one that matters. April 15th is not a test of character. It is a checkpoint in a financial reporting cycle. The extension simply adjusts that checkpoint within the rules. There is no virtue in filing a return that you know needs more reconciliation. There is no badge of honor for guessing. And there's no shame in saying, I want this to be right. Strong business owners prioritize accuracy. They understand that long-term stability matters more than short-term optics, and tax compliance is long-term stability work. So if you're feeling that tightening in your chest right now, the pressure to be done, pause. Ask yourself whether the pressure to proceed. Ask yourself whether the pressure is procedural or emotional. If it's emotional, breathe. If it's procedural and you truly are ready to file, but if you need more time to make your numbers defensible, the extension is not an escape. It's a structured, lawful pause. And that is a sign of leadership, not failure. All right. If you're listening to this and thinking, okay, I'm definitely not ready for April, here's your zero fluff action plan. No drama, no shame, just procedure. Step 1, decide early. Do not wait until April 14th at 10 p.m. to make this decision. If you already know your books aren't reconciled, if you're missing documents, if your brokerage just issued a corrected statement, make the call now. Filing an extension is simple. It's automatically, but waiting until the last minute adds unnecessary stress. Calm decisions are better than pressured ones. Step 2, file the extension properly. For individuals, that's Form 4868. For businesses, that's Form 7004. File it electronically if possible. Get confirmation that it was accepted. Do not assume it went through. Verify acceptance. Compliance is about confirmation, not assumption. Step 3, run a reasonable estimate calculation. You do not need perfection. Pulls last year's return. Look at the total tax liability. Compare it to this year's revenue and profit. Has income increased, decreased, stayed similar? Look at total bank deposits, payment processor totals, payroll reports, estimated payments already made. This is about reasonable approximation, not guesswork. Step 4, make a good faith payment. If you believe you owe $5,000, send $5,000 if you can. If you can't send the full amount, send what you reasonably can. Remember, penalties and interest generally apply to the unpaid portion, not the entire estimated liability. Partial payment reduces exposure. Avoid the "I'll deal with it later" mindset. Step 5, reconcile every account. This is where the real work begins. Bank accounts, credit cards, loan balances, payment processors. Every account should reconcile. If you don't reconcile, you don't actually know your numbers. 6, match income to 1099s. Pull every 1099 you've received, match it to deposits. If there's a mismatch, figure out why. Was income reported under a different EIN? Was something double counted? Was something missed? Alignment reduces correspondence. Step 7, review major expense categories. Don't get lost in the $18 supply receipts. Look at the big categories first. Advertising, contractor, cost of goods sold, travel. Are the totals reasonable compared to prior years? Large unexplained swings should have explanations. Step 8, review carryovers, net operating losses, depreciation schedules, passive activity carryovers. Make sure prior year positions were implemented correctly. Carryover errors compound over time. Step 9, set a summer filing date. Do not let the extension drift into October panic. Pick a date in June or July. Block it on your calendar. Treat it like a board meeting. The extension is structured pause, not indefinite delay. Step 10, finish before the deadline. October 15th should not surprise you. You had 6 months. Use them intentionally. Now let's talk about what not to do. Do not use the extension period to find extra deductions. Do not inflate expenses to offset a larger than expected tax bill. Do not ignore estimated tax payments for the current year. The extension addresses last year's filings. It does not replace current year planning. And finally, here's the mindset shift. The extension is not about being behind. It's about filing once accurately instead of filing twice to correct errors. Compliance is not a race. It is a reporting cycle. And if you use these 6 months to reconcile, verify, document, and file cleanly, you are operating professionally. That's the zero fluff approach. Let's zoom out for a moment. Tax season is not a single day. It is not April 15th. It is not a race to see who can file first. It is a reporting cycle, a documentation cycle, a reconciliation cycle, and the extension is simply one of the tools built into that cycle. It is not rebellion, it is not defiance, it is not procrastination unless you choose to use it that way. It is structured time, and structured time used properly increases clarity. Now I want you to think about something. 5 years from now, you're not going to remember whether you filed your 2025 return on April 10th through July 12th. But you will remember whether your books were stable. You will remember whether your records were defensible. You will remember whether you operated from panic or from procedure. The IRS does not reward speed. It rewards alignment. income reported that matches third-party documents, expenses that are documented, carryovers that are consistent. That's what matters. And if you need more time to ensure that alignment, the law gives you more time. That is not weakness. That is compliant structure. Now, let me say something clearly. The extension is not a shield against responsibility. If you owe tax, you still owe tax. If your bookkeeping is behind, you still need to reconcile it. If your documentation is thin, you still need to strengthen it. The extension does not erase obligations. It adjusts the filing timeline. That's it. But sometimes that timeline adjustment is the difference between guessing and verifying. And verification is powerful. Verification reduces stress. Verification reduces notices. Verification reduces amendments. And verification increases confidence. I've worked inside the system. I've seen what gets examined. I've seen what generates correspondence. It is not the filing date. It is the substance of the return. So if you're sitting there today thinking, I'm not ready, that is not a confession. That is awareness. Awareness is step one of responsible compliance. Now, the next step is procedure. File the extension properly, make a reasonable payment, use the time intentionally, finish clean. That's the strategy. And here's something else I want you to hear. You are not on a list because you extend. You are not flagged because you need more time. Millions of taxpayers extend every single year. Professionals extend routinely for complex returns. The system expects it. It processes it. It's normalized. What is not normalized and what does create problems is rushing, guessing, and correcting later. You do not need to prove anything by filing early. You need to file correctly. That's the only metric that matters. So if this episode has lowered your heart rate even a little, if it replaced anxiety with clarity, share it with another business owner who is staring at April and feeling pressure. Compliance should be calm. Compliance should be procedural. Compliance should never feel like shame. Next week, we're diving into something that pairs perfectly with today's conversation. Commingling cleanup. What to do when you realize you've been paying for Netflix out of your business account or your business software out of your personal account. We're going to fix it without panic, without self-judgment, and without fluff, because that's what we do here. We make bookkeeping understandable. We make records defensible, and we make compliance calm. I'm Lauren Twitchell. This is the Zero Fluff Books podcast, and we'll talk again soon.